there's only a couple areas where money flow is going. So with last month's news being about crypto brokerages going under, this week's news has been all about the banks. A little bit more serious now. And with the way First Republic Bank is trading, it seems to be that people are concerned this could be the next one to fall. And even though the interest rate environment is rising and banks are collapsing, Jerome Powell still seemed to find it necessary to raise 25 basis points, what makes me believe that the banks are just not out of the woods yet, and neither is the economy. Let's get into it.
Professor Siegel, look, I mean, the Fed went through with the quarter-point hike. A lot of criticism, and the bond market had a pretty profound reaction to it, given that it came at this time in financial instability. Jay Powell and other officials making the case we can fight inflation with higher rates with one hand, and with the other, we can take measures to try to ensure banking stability. Do you agree that's possible?
No, I don't. And let me tell you, Michael, how absurd the Fed's conference and projections are. They lowered their GDP projection for this year to 0.4%. Now, we already know that the first quarter is over 2%. In fact, the Atlanta Fed GDP now is at 3.2%. So this means that the Fed is projecting negative GDP growth over the remaining 3 quarters of this year.
Look, they've been telling us for over a year that they're only going to change policy in a dramatic way if they see inflation coming down in the here and now. Do you think that that type of stance has essentially gotten stale? I mean, look, the banking system is showing some level of distress, and the bond market, as I was saying, is set up in such a way that it's kind of calling out for the Fed to get easier.
I find it interesting that Jeremy picked up what I picked up. And that's the fact that the Feds are calling for a recession, but the market doesn't even know that they're calling for a recession. Now, if you've been following Jeremy Siegel, he's definitely been a perma bull here. He thought the economy would remain strong, and now he's definitely questioning that thesis, or at least questioning to what the Fed's objective is here. I just think that they can't keep tightening without breaking something, and that's been our thesis for about 18 months on the channel. And so I want to just put into perspective exactly what is going on here, because while the Feds are tightening, what else are they doing? They're actually expanding their balance sheet substantially here. We all know that they're putting in a backstop for a lot of the banks, and that's hopefully going to prevent people from going on massive bank runs here, as basically your top 3 banks are probably the ones that are going to get the majority of the deposits here. Your JP Morgan, your Wells Fargo, your Bank of America. We noticed early on that the financial institutes were underperforming the XLF, the actual index of the finances. And so we knew that there was some smoke there, and where there is smoke, there is fire, and we're starting to see that fire go into a blaze. This was about a week before the SVB collapse happened. Off of the GDP forecast that the Feds are projecting here, they're expecting the back half of this year to be a bumpy one. Now, the only delay with my thesis is going to be the fact that I need a confirmed recession. Once we get a confirmed recession, we get the market bottom. And I just can't declare a market bottom if the Feds are still tightening and things are just starting to break. This is the hardest part here. This is why timing the market is very dangerous, and we don't recommend it, but I do my best to give you guys some clarity on what I think is going on here. So what are we starting to notice? Well, there's definitely some stability here in the market. We're in a trading range of roughly 3850, 40 to 4200, and this has been a substantial trading range. And we'll go over the charts here in a minute, as I've had these earmarked for a substantial amount of time, right around a year now. Anytime we get up to 4200, usually a good time to take some profits. And anytime we get below 4,000 with a elevated VIX, usually a good time to take some positions. So there's definitely been a tight trading range here, and using the VIX has been pretty much ideal. But let's talk about exactly what's going on from a macro perspective here. We are seeing money flock to specific areas, and this is what I really want you guys to pay attention to here. There's only a couple areas where money flow is going. Number one is going to be the triple Qs, mainly made up of Nvidia, Apple, Microsoft, Google. That's where most stock money is going to. And what is that doing? That's propping up the actual S&P. Why is it propping up the actual S&P? the majority of the S&P is really made up of these companies. So while we're getting massive underperformance in the S&P 500, because most money is flowing to these 4 to 5 stocks, it's keeping a bid under the overall index. But what else are we noticing here? Well, those companies are definitely getting elevated from a valuation standpoint. And once we get a correction in that, I think we get a correction and a bottom in this market. When will that come? I'll go over the charts here in a minute, but most of you that are subscribed probably know the time period that I'm looking for. So let's talk about exactly what else is going on here. Well, crude oil is telling us that there is demand destruction and we are going to see layoffs here soon. And you're probably asking yourself, well, how are you getting that from crude? Well, crude oil has been selling off drastically. And so the futures market is betting that there's not going to be as much traveling taking place, as many people going to work, and people are really going to watch their spending habits probably come this summer. We're going to see a slowdown in this economy. Crude oil is the first one to kind of tell us that. We are seeing an explosion in the gold market, which I am not going to be shocked if we break 2,000 on gold probably in the next month. Could be sooner, but I imagine that there's going to be some bid support, and after the Fed's meeting, I think people are just going to be content in the positions that they hold, and there's no real catalyst on the table right now. So therefore, I think we're going to see a little cool down in gold. We'll probably see a little pickup in the market, maybe start brushing up to 4,050 on the SPY, with the triple Q still leading the way, as that seems to be the stronger of the indexes. But what is the one thing that has been screaming recession? You guys know the answer to this one. It's definitely going to be the treasury market. So we still have a massive inversion from the 3-month to 10-year, which has predicted recession with 100% accuracy. And I want to throw that disclaimer out there because for some reason, people have been wanting to ignore this one for a very long time. Not sure why that is. Not sure why people want to ignore the gold run. Not sure why people want to ignore what the oil markets are telling us. The only market that seems to be in denial is the stock market. And I don't even think that's in denial. I think that money is just flocking to the top companies that are not reliant on financial institutes right now. And so what is that doing? That's propping up a bid in the index, as I stated earlier. But the inversion has been the problem. So the inversion is telling us that growth is slowing, oil is telling us that growth is slowing, and the flock to gold is telling us that big money is scared. We also noticed that yields were collapsing this week. What is that telling us? Well, people are now flocking to the longer end of the yield curve. So first thing I want to point out is the clear head and shoulders pattern that Bank of America had. This is the Bank of America chart, and we told everybody to watch out here as this was a clear head and shoulders pattern formulating, and the financials were looking a little suspect here as they were underperforming the XLF minus JP Morgan. JP Morgan actually was holding strong, but more of your Wells Fargo, Bank of America, and some of the other regional banks were definitely displaying some softness here when compared to the actual financial indexes. And so when we dug into Bank of America, one of the largest banks here, we noticed the head and shoulders pattern formulating and said that something is not right here in the financial system. And lo and behold, what happens? SVB collapses, FRC is now on deck. And so some things are taking place here that was signaling from the financial market that things were going to happen. So guys, you have to pay attention to the charts here. I mean, they've been really, really accurate, but let's specifically talk about where we are on the S&P 500. Some people that were definitely more bearish on the market became more bullish after this move and after this breath. And if we went back in history, this is actually a normal breath in a bear market. So if you believe that this is a bear market, then you would know that you have to still be a little bit more defensive. But it seemed to trick a lot of the experts, as now I tend to think that we're in this middling ground here where I really can't formulate a super bull case or a super bear case. I'm very neutral, but when I look at the economic backdrop, I tend to lean that recession is still absolutely on the table, which means that the market bottom might not be in here. One thing I do really want to point out, ladies and gentlemen, before we get into the actual chart is money flow here. Money flow is actually a pretty substantial divergence to what the market is doing. Tons of money are coming out of this market. There's a lot of fear. And as we know, a lot of money is actually flocking to treasuries and money markets, as you can get paid over 4% now for idled money. And with the volatility of this market and the uncertainty of this economy, makes a lot of sense for people to be on the sidelines. And there is a tremendous amount of money on the sidelines, which makes me think that we could have some sort of rip your face off rally with the amount of money on the sideline. So just something to keep in the back of your mind. The yellow lines that I have drawn here is basically that 3,800 to 4,200 that I talked about earlier, this range bound. And we got a beautiful sell signal right off of that as well. So this has definitely been something reliable. And now we're in some middle ground. We almost touched the bottom of this. We almost touched the bottom of the range and then rebounded back up. And now we're above the 200-day moving average. But if you've been following the channel, guys, it's really the cloud that I've been paying more attention to, and the 50-day moving average. Being below the 50-day moving average, being below the cloud, is telling me that there's probably going to be more pain ahead come June, and we'll get into that in 1 second. But we're seeing the divergences of longer-term trends versus the shorter-term emotional volatility in the market. The shorter-term emotional volatility is saying that everything's fine. But as we learned from Jeremy Siegel, the Feds basically came out and said the back half of this year is going to be brutal. Market's not really pricing that in my opinion. We do have some bullish sentiment here, though. We broke above the 200-day moving average, which is this pink line, which is very bullish. We also got a MACD rolling up here and heading to the upside. We have money flow coming out, RSI's pointing up, and the McClellan oscillator is formulating a really, really nice uptrend. And it'll probably tap out at the 50% mark here. As I stated before, I do think there's an opportunity to back test this trend line, basically going 2.5 to 3% to the upside. April, May, and June look like a pretty high risk period, but I threw mid-March in there just to be safe, as it's uncertain to what the Feds are really trying to do here. They tell us one thing and they do another. I don't want to say what they're doing is stimulus, but backing the banks and expanding their balance sheet, anytime a balance sheet is expanded, I just have to lean to the fact that there is some sort of stimulus, and that definitely is giving a bid to the market. So if we go back a little over 2 years ago, we're basically trading in the same range that we were trading before. What I want you guys to pay attention to is what I think is formulating on this. We know that the biggest risk period is possibly coming in June. But what else is taking shape here is we could have a possible head and shoulders pattern formulating here with shoulder line here, a head here, and are we formulating another shoulder line here that's going to lead us to that June area? And that's what I think is happening right now. So I think we're going to get some consolidation. I think we can back test this trend line. And as long as we stay below the recent high here and start formulating a right shoulder, I tend to think that still lines up pretty solid with June here, guys. This is phenomenal stuff that we're seeing. So as always, guys, appreciate your time. Make sure you drop a comment. Let me know what your thoughts are, and we will see you in the next one. Peace.